Opendoor stock just wrapped up Thursday's trade with another strong showing, closing the regular session at $9.09, up 86 cents or 10.45%. At one point intraday, the stock even touched $9.21, a level that seemed almost out of reach just a few days ago. But after two huge green sessions in a row, the aftermarket saw the stock cool off, dropping about 24 cents or 2.64%. Now, the natural reaction for some might be to worry that the rally is fading, or that this is the start of another slide. But I want to frame this clearly. What we saw in the aftermarket today looks far more like profit-taking and healthy consolidation than any kind of negative reversal. Let's break down why. First, context matters. Over the last 2 trading days, Opendoor stock surged more than 26%. That's a massive move in such a short period. No stock moves up in a straight line forever. After 2 days of intense buying, some traders locking in profits in the aftermarket is completely normal. In fact, it's healthy. It shakes out short-term players and allows the stock to reset its base before the next leg higher. Think about it this way. If you bought shares on Tuesday in the low 7s, you've already seen nearly 30% gains in 48 hours. Of course, some people are going to trim their positions. That's not a sign of weakness. It's just the market doing what it does, transferring shares from short-term hands to long-term ones. Second, and perhaps more importantly, there were no negative catalysts behind the aftermarket dip. No bad filings. No surprise announcements. No analyst downgrades. No fresh insider selling. Nothing came out in the news that would explain a shift in fundamentals. When a stock drops on new negative information, that's cause for concern. When a stock dips modestly after a big run-up, with no negative news, that's just the rhythm of the market. So if you're long, the key takeaway is simple: don't confuse healthy cooling with actual weakness. Now, let's move on to what did come out today, because there were some important developments worth highlighting. Kaz Nejatian, Opendoor CEO, responded to a post online by saying the company is 90% sure that a new product will launch in one market next week. He even hinted that the market in question is likely Texas. This is a big deal for a couple of reasons. First, it reinforces the culture of speed that Kaz has brought to Opendoor since taking over. This is not the cautious, consultant-driven, PR-heavy Opendoor of the past. This is a company that's now teasing and testing new products in real time. It's agile, it's responsive, and it's willing to engage directly with its community. Second, the fact that the first launch market could be Texas is symbolically important. Texas is one of the most active housing markets in the country. It's diverse, it's high volume, and it's a place where real estate trends often spread nationwide. Rolling out a new product, there is a strong signal that Opendoor wants to stress-test innovations in a market that really matters. Third, Kaz's willingness to give a probability, saying 90% sure, speaks to the transparency he's trying to cultivate. He's not promising with 100% certainty, but is showing confidence and intent. That kind of open communication builds trust with both employees and investors. And this ties directly into another theme we saw today: culture and accountability. Keith Rabois, who has returned as Opendoor's chairman, made a point of saying he wants to see people doing real work in the office, not from home. This aligns with Kaz's earlier announcement that Opendoor will become an in-office company starting next week. Now, on the surface this might sound like a small cultural note, but it's actually part of a bigger reset. Keith Rabois and Eric Jackson have both signaled that Opendoor needs to get leaner, faster, and more accountable. Moving people back into the office is about increasing focus, collaboration, and execution speed. And frankly, it may also be a way to organically thin out the workforce. Those unwilling to make the shift will self-select out, leaving behind a tighter, more committed team. For investors, this matters. Because one of the biggest critiques of Opendoor in the past has been inefficiency. Too much bloat. Too much time wasted. Too much reliance on external consultants and PR agencies. That's not how you build a disruptive tech company. By making moves like this, ending remote work, demanding real accountability, Kaz and Keith are rewriting the DNA of the company. So, let's put this together. On the one hand, you've got a stock that's cooled slightly in the aftermarket after a huge 2-day run. That's normal. On the other hand, you've got leadership signaling speed, transparency, and cultural reset, and you've got a new product potentially launching in Texas next week. That's not normal. That's exciting. And when you zoom out, the fundamentals of the story remain very much intact. Jane Street's 5.9% stake, disclosed earlier this week, is still fresh. Access Industries' 12 million share exit is in the rearview mirror. Lennar's $71 million mark-to-market gain on their Opendoor position in Q3 earnings is a reminder that even inside the housing industry, Opendoor's relevance is being validated. And the August housing data showing new home sales up more than 20% year-over-year still provides a supportive macro backdrop. Nothing about any of that has changed just because the stock dipped a few cents in the aftermarket. Let's also not overlook the role of the open army in all of this. Earlier this week, sentiment was at its lowest. The stock had just suffered 4 red sessions in a row. Retail investors were questioning their conviction. There was finger-pointing. There was frustration. And then, seemingly all at once, momentum turned. The Jane Street disclosure landed. Housing data came in strong. And suddenly, those who held firm through the storm found themselves rewarded. That's not an accident. That's what conviction looks like. And today, even with the aftermarket dip, the bigger picture is still clear. Those who stayed patient, those who stayed focused on the long-term story, those who tuned out the noise, are the ones now sitting on gains and watching the narrative shift. So, to the open army, well done. You weathered the storm. You endured the toughest days. And now, even on a day when the stock dipped modestly after hours, the long-term trajectory looks brighter than ever. One final point I want to make. At $9 per share, Opendoor is still trading far below its all-time highs. Even after 2 monster days, the stock has an enormous runway ahead of it. And with innovation rolling out, with housing demand proving resilient, with institutional support growing, and with leadership laser-focused on speed and efficiency, the potential for upside is still significant. That's the lens to use here. Don't get hung up on every cent in the aftermarket. Don't let small dips after big runs shake your confidence. Look at the trend. Look at the fundamentals. Look at the cultural reset. That's where the real story is. So, what's the takeaway from today? Opendoor closed Thursday strong at $9.09. The aftermarket dip was nothing more than profit-taking after 2 huge green days. Kaz confirmed a new product is likely launching in Texas next week. Keith Rabois doubled down on accountability and in-office execution. And the broader institutional and macro backdrop remains supportive. This is not weakness. This is consolidation. This is strength being tested and confirmed. The storm has passed. The open army held the line. And now, with momentum shifting, leadership executing, and institutions stepping in, the path ahead looks as compelling as it ever has. Onwards and up.